Good afternoon, everybody, and thanks for joining us for the October Fireside. What we're gonna do, cover a couple of things. So for those of you in the Tuesday meeting, I kind of mentioned we obviously talk about interest rates as we usually do. Well, at any event, but this one routinely. The shutdown, just the impact, and really that's been low impact for the moment. So we'll talk a little bit about that, and then we're going to touch on our portfolio products, also known as non-QM, DSCR. So we'll touch into a few of those and get all on. So as always, please just jump in anytime, unmute yourself, ask a question, or drop into the chat. With the chat, Don and Chris are on here too. I think I saw Chris a second ago. Did I not? Nope, just Don. My bad. So yeah, Don, if I'm missing anything in the chat, definitely let me know, and I'll kind of dip back and forth with you guys. So again, thanks for joining me. Hope everybody's having a good day. And where I usually start off our little presentations is just to kind of give you a little bit of a feel of temperature of what the market is. Mortgage News Daily, for me, referenced this before. It's kind of just a somewhat not as commercial sort of source that does a survey for interest rates nationally. In a post here, this is the 30-year rate, and this is with either 0 points or very thin points, assuming good, strong credit. So for those of you who were on the coffee talk about a week and a half ago, I showed you, hey, look at the Federal Reserve Board met on September 17th, and rates jumped up 1/4%. So for those of you who didn't catch that last meeting, something just to point out that when the Fed does something, it's usually forecasted and expected. So there's two more Federal Reserve Board meetings this year, October 27th and I think December 10th, if I'm not mistaken. Right now, today's interest rates in the market are expecting 1/4% drop for each of those two meetings. Would you agree on that, DJ?
That's correct.
Yep. So if nothing else were to happen in the economy, and believe me, stuff will, but if nothing were to happen in the economy and the Fed dropped 1/4 now and again to December, the interest rates we're looking at might end up being exactly where they're at. So this is always tough to explain to the consumer that says, hey, when the Fed drops 1/4% on that Wednesday afternoon at 2:15, mortgage rates are going to drop 1/4% at 2:16. This is everything's sort of forecasted and sort of playing out. So weird month because normally first Friday of the month is job numbers. If you look back through here, these dips that we saw here, you're coming at first of July, we're at 1st of August, 1st of September here. These are all unemployment numbers, unemployment reports coming out. Well, because of the shutdown, we did not get unemployment numbers last Friday. There was still, ADP reports and other numbers. So there's still a way to kind of sort of take the temperature of what's happening. But we're without information, and there's a lot of data not being reported outside of that. But so anyway, that's as far as where rates are going. I like talking about where rates have been. I'll let Don talk about where rates are going. But generally speaking, there's not a whole lot of optimism that we're going to be like under 6% anytime real soon. That can happen. I think, mid sixes is probably a pretty safe expectation to expect here. And if we get anything better than that, if we stay, get back into the low sixes or high fives, we'll be doing cartwheels. But Don, what do you have to say on that?
In reality, if Fannie and Freddie's not predicting rates below 6% by the end of 2026.
Yeah.
So I think right now, when you get these little dips like this, borrowers should allow us to quote them a rate with at least a cost of 1 point, because we could push them pretty much down to 6, maybe 5.99 on any given day, depending on the down payment and credit scores. So there's no, for borrowers, there's no, I must say, refinance party coming anytime soon. Anybody can guarantee. We've been in a refinance market talking about it for the last 2 years. It hasn't happened. If it has happened, it's happened for about a day or two or three. So I think borrowers are wiser right now to pay a point or so, get that rate down below 6, get it into the mid fives on a 20-year term, and take advantage of where things are right now. Buy the house, buy the rate down, and don't worry about a refinance market. If it comes, it comes. Because right now we've been talking about it for 2 years, it hasn't come.
Yeah, and you're never going to time the market. I can tell you all the people I talk to about refinancing from here all the way to here, most of them are holding out for something better. And then a few people who pulled the trigger here going, ah, crap, I missed my window. I might as well go ahead and do it anyway. So the 20-year fixed, I know we talked about that on the last two calls, but a shorter term loan, of course, yields a higher payment, but a 20-year rate you can get pretty comfortably under 6 points with, or excuse me, under 6% with 0 points. And a 15-year, of course, even a little bit better than that. So a conversation we're having with everybody. It did have a customer. They're downsizing and only going to end up with $100,000 loan. And we talked about a 30-year fix, and I kind of just said, hey, just so you know, 30-year fix is going to yield the lowest payment, but here's what a 20 and a 15 looks like. And I can't remember exactly. I think her payment went up $45, but she's taking 10 years of interest off of that loan. She's running and feeling good about that. So. Cool. I'm going to move over to the shutdown here. Jump up here. So this is more or less an internal thing, but it just kind of give me a good guide or checklist. So when a shutdown happens, and it doesn't it's not that rare. Seems time anytime there's a shutdown looming, guess what happens? There's a shutdown. So I'm just going to run through these pretty quickly, but Cavers is excuse me. Cavers is anytime you have a government loan, there's an alert system to make sure that somebody doesn't delinquent on other federal debts. Not impacted as it stands right now. Um, if you have somebody, give me a quick example. If I have an applicant who's buying a home with an FHA loan, we run them through this Caver system, and it'll tell us if there's an alert like, oh, geez, you went bad on another FHA loan, or more likely they have a student loan that's delinquent or default. Right, that would kind of put the brakes and say we can't give this person an FHA loan. So that alert system is working. However, if there's a correction or an update or dispute, that's not working. So not many people are going to fall into this, but getting a problem fixed, that is being impacted by the shutdown. The Federal Reserve, right now, no problem. We can still fund loans and get everything moving pretty quickly there. FHA connection, which is needed to start loans, to order appraisals, get appraisals through the system. All that's the same. FHA customer service, realtors, you yourself don't likely ever need to call the FHA customer service, but lenders do. This is usually for oddball, weird scenarios that are kind of one-off that we have to run through FHA. Lightly staffed, so you might get longer answers, longer turn times and delays a little bit there. But really, your day-to-day is not going to be too much impacted. FHA appraisal. So generally speaking, it's hard to do appraisals, or excuse me, I'm sorry, condos. It's hard to get condos approved for FHA. If it's already on an approved list, the condo has to get approved by the head office. Which right now they just put the brakes on that. Again, very, very small percentage of the market and probably everyone's market sort of piece of their business, but nonetheless, it can be impacted, but on a very, very small level. FHA still closing loans. Flood insurance, they have the limited ability to issue new policies. If I'm not mistaken, I think there's going to be a time where it's going to get much more difficult, or flood insurance policies just won't be issued. But those are happening right now. Fannie Mae, Freddie Mac, who are essentially, in conservatorship, so the government does have plenty to do with them. Right now, no impact. HECM loans or reverse mortgages, those are if you have something in closing, it's still going to close, but if it's in process, you might have a problem there. Again, pretty small the real estate, realtor market, but nonetheless, it could impact things. Let's see here. Social Security, sometimes we have to verify someone's Social Security number because maybe they immigrated here to the United States and they got a Social Security number, obviously years after they were born. There's a validation that have to be done. That can be hung up. There can be some issues there. There are some workarounds with it, but that can happen. Tax transcripts. Right now, this is okay. So what happens is if Elliot were to apply for a mortgage today and we're verifying his income and say, oh, he's self-employed, we have to verify his taxes were filed with the IRS. So we contact the IRS and they send us transcripts. Right now, that system is still working. That department is funded, but that again may run out at some point in time, we're being told, but as it stands, business as usual. What'll probably happen is it'll be delayed and then eventually turned off, but right now, so far, so good. Um, USDA loans. So USDA loans, as I mentioned in the meeting yesterday, not a huge part of our market, but certainly in Ohio, it is a big chunk of business, but it's a zero down, program if you're buying in a rural area. That is essentially shut down. The staff is on furlough. There's nobody to approve those. Those aren't just cross-country underwriting approving it. There is kind of a secondary. It's through the state technically, but that is shut down right now. So if these little, self-employed, USDA, FHA condo approval, if any of these buzzwords are hitting you on a transaction, call the loan officer. You should be staying in touch with all of your loan officers on every transaction. Better yet, that loan officer should be staying in communication with you, like Don, Chris, and myself like to do. But always stay on the front foot, on the offense, just making sure that there's no problems. So just make that phone call. Hey, shutdown impacting our buyers at all? Hey, I hear they're self-employed. Is there anything I need to worry about? So just be aware on that. So where it could be impacted is employment verification. So what if you have somebody who works for, a government entity and they are not currently going to work right now? That obviously may be a problem when we do an employment verification. I think I saw in the news, like over the next couple of weeks, there's different positions that'll be kind of phased out because of funding. I think I heard something, and I kind of heard this secondhand, but air traffic controllers at one point they're only going to get half paychecks, and then at another point they're getting no paychecks. And I don't know if that means they don't have to show up to work. They just show up to work with the understanding that they'll get back pay. But these are things. Okay, well, what happens when I'm doing a loan for an air traffic controller and I do an employment verification? There's no, they're like, oh yeah, he still works here, she still works here, but we're not paying him right now. Is that still okay? I don't know how that's going to show up in an employment verification, but anyway, these are things that as we get deeper into, if this goes into November, which it very likely can, you'll start to hear a little bit more along those lines. But Don, anything not correct that you need to correct me on there?
No, but on the air traffic controller, they shouldn't answer it. He's not being paid right now. They should answer it. Will he still be employed? Yes, we need him because there's a shortage.
Yeah, that's right. Good
So
point.
that's how this should be answered. But no,
So
you're
then
absolutely correct. In reality, they're really, the shutdown's really not affecting us.
thankfully, knock on wood, it's been
Yeah.
in times in the past, some of these kind of alerts that kind of like no impact, no impact, no impact, they did have an impact. So whether it's been, better planning or whatever goes on the mortgage side, we're dealing with it, pretty well, all things considered. Cool. All right. If anybody has any questions, feel free to jump in. As I mentioned, I'll kind of cruise on here to this. So, what I'm going to do, I'm going to actually, before addressing this, I want to talk about the Tom Ferry event again. So, some of you may be sick of me hearing about this, and I'm going to jump into the chat. I'm going to drop in a few quick items here. One is there's a PDF of the flyer that I'm about to walk through here, and then also,
Do you have the agenda, Sean?
what's that?
Did you have the agenda you could put in there too, or no?
Oh yeah, you know what? I will come back to if
Okay.
you happen to have that and want to dump that in there, that'd be great. Sorry. Everyone's faces keep going over where my mouse is supposed to go. So I'm going to put this in here too. So the first one's just a sheet of the flyer I'm going to kind of walk through here, use as a guide to talk about our portfolio programs. The next one is the Tom Ferry event. So for those of you, the Tuesday meeting, I described Tom Ferry as the Taylor Swift of real estate coaching. So that's big. Tom Ferry is apparently the premier and go-to. So his event here in Cleveland costs $219 to go to. However, if you register as a guest of CrossCountry Mortgage, it is $0. 8 to 5, I believe lunch is included, and there's a happy hour after. We have an agenda which we just got here today that we might be able to upload here for you, but it's a can't miss event. It's the day after the business clinic, a business planning clinic at the KWGM office. So I know back-to-back kind of full days might be a lot. At the same time, I would say there's no better program to follow up the business. I'm guessing a big part of the business planning clinic is getting listings. Why not just take that the following day and just cross that off your list? So anyway, just wanted to push that out there. I did see a few more people signed up yesterday after the meeting, so I was glad to see that. And you're welcome to invite other, realtors events without KW. That's more than fine. Or if you've got an assistant or somebody who you think would do well by being there, please do share that. We are going to be capping off the attendance at some point, but we do still have room as it stands right now. So there we go. All right. So this is to getting into our portfolio program. So non-QM is kind of an industry-wide term. Portfolio lending, we tend to use that one for what we offer because what non-QM is, it's basically not Fannie Mae, not Freddie Mac, not FHA. I used to call it outside the box, but I think even that's probably making it sound like it's more that's it almost negative. It's usually nothing negative that takes us into this, but something that may just have an advantageous to go here or something, I don't know, creative, some might say. But we do these, we underwrite these. A lot of banks, a lot of bankers, a lot of brokers do not do anything in the range of what we're about to talk to. A lot of them that do it on a broker relationship. So yeah, you're talking to the loan officer, but this file is getting sent off to a different company, and they've got little to no influence. The communication often is poor. The turn times are often not as good. This is a cross-country mortgage underwritten product. We're funding our loan, or excuse me, we're funding the financing and the loan for this at closing. From CrossCountry Mortgage. So anyway, it may not sound like a big deal, but if I'm talking to a room full of loan officers, you're going to raise some eyebrows going, oh, okay, cool. That's kind of cool. So what I'm going to do is kind of just use this template more or less just as a kind of a guide to talk through what some of these programs are, some of the advantages, and Don, obviously feel free to chime in here, but bank statement program. So I'll kind of explain some of these for uh, with examples that may or may not fit something that you've seen before. But let's say you got somebody who is self-employed, and let's say they've owned their business for 4 or 5 years, and they've got a really good accountant. Loan officer's worst enemy is a good accountant because an accountant oftentimes is going to say, "Oh yeah, this business made $120,000 last year. Let me get to work on that and see if I can't make that a little bit lower." So they find expenses and write-offs and this and that. And when all is said and done, they're down to $50,000 a year. Making 120 a year versus $50,000 a year is two very different qualifying ranges. So if they don't qualify at the $50,000 a year, an Audible or a different program that we may want to consider is the bank statement program. This is where instead of saying, show me your taxes, I'm going to count their income, what you claim with the IRS, plus or minus some additional adjustments we'll make. Don't send us your taxes. We want to verify that you own your own business, but let's just look at your bank statements for the last 12 or 24 months, and we're going to look at your deposits. Okay, you've got $15,000 in deposits average going in over the last 12 months. That's $180,000 a year that we're going to qualify you on. There's some calculations. There's a kind of write it down by a certain percent, but
Essentially, take 50% of that, essentially, Sean.
50%. So in that example, it might be a $90,000 a year income. And obviously, with some businesses, revenue can vary, and it can be pretty. I mean, I've seen people where someone's revenue is 2 million and the expenses and write-offs are 1.9. It's like, oh, okay, cool. So you go from $2 million in revenue down to $100,000 in income. There's a lot of different ways you could make this work. We can look at personal income, asset statements. We can look at business, but it's a really phenomenal program. DJ?
It was essentially taking the 50% haircut on that. I think if we get the accountant or CPA, it has to be a CPA, not an accountant, get a CPA to write a letter regarding expenses. I think sometimes you can go to 35% versus a 50% expense.
And this is a program. We just call it the bank statement program. So it is known. A lot of first-time home buyers, or excuse me, I'm sorry, self-employed buyers or who accountants, investors, they're familiar with these for sure. The 1099. So the 1099 program might be appealing to anybody on this call who owns a real estate license. If
Love
you
that program.
what's that?
I love this program.
It is a fun one. So let's take a similar example. Let's say you've got somebody who had $100,000 in 1099 income, but they're writing off, let's say they're a realtor, they're writing off their signs, their mileage, their contract assistance, and fees, classes. And when all is said and done, they're at 50,000. At that 50,000, again, might limit them on what they're qualified for. How the 1099 program is saying, you know what? Don't send me your taxes, send me your 1099. Okay, cool. $100,000. I'm going to take 10% off of that. I'm going to consider your income to be $90,000 a year, regardless of what your write-offs and expenses are. With these programs, there's a slight, bump to the interest rate. You're not going to get the Fannie Mae, Freddie Mac, 30-year fixed at whatever the par rate is. It is going to be a little bit higher, so we are paying a little bit of a premium, but often this is making the difference between getting into a house and not getting into a house. So this program, I love it. Believe me, not even you look or even open up the tax returns and just looking at one little, 6-inch by 3-inch piece of paper to verify the income is streamlined. And of course, it's oftentimes a bigger number than anything else we're going to see on the taxes.
Sean, in these programs, anytime you see non-QM, you should really think anywhere from 1 to 3% higher in interest rates over the market rate, depending on credit scores and program used. Ideally, most of these programs are going to be somewhere in the 7s or 8s. You get into some really crazy ones like no ratios and lower credit, you're going to be 9s and 10s. But the trade-off, you can either pay the IRS or you can pay it in your mortgage payment.
Yeah, you don't like these programs, go pay your taxes, as DJ likes to say. Cool. Asset qualifier. This is one where I don't know if anybody's ever had a customer be like in a situation, I mean, where someone says, I could pay cash for this house, but I still can't get a loan. How does that work? Well, Fannie Mae, Freddie Mac, FHA, they're looking at debt to income ratios and they're looking at income. And there's different ways to extrapolate income, even if you're not working, dividends, interest, retirement distribution, Social Security, pension, all these things. But how the asset qualifier works, I'll give you a quick story. Had a couple who they were in their kind of late 50s and both divorced. One was a more recent divorce, but anyway, they were buying a house together. In this case, the wife was just divorced. She was to be receiving potentially alimony, or spousal support, but it hadn't started yet. And even if it started right away, we wouldn't be able to count it. The boyfriend in this case just literally retired, but it was so recent, no Social Security, no pension, no retirement income. So between the two of them, we had zero income to count. But they were looking at a $500,000 house, putting down $250,000, and they had $800,000 in the bank. So we get this. The mortgage world applies some bit of common sense here, going, wait a second, you want a $250,000 loan, you've got $800,000 in the bank. These guys have very good credit scores. They're putting 50, 60% down. Why wouldn't we do this loan? We did. Paid a little bit higher interest rate, about 0.75% to 1% in interest rate, and they're living happily ever after. So that's the asset qualifier. So it's not just, okay, do you have what you're going to owe? There's some more to it because we are looking at other debts and all of that. So there's a little bit more common sense approach as far as the bank not just willingly giving a loan to anybody who has enough to pay it off. There's a bit more of a litmus test, but it's a great program. Any comments or questions on that? Investor cash flow, or DSCR, which say it stands for debt service coverage ratio. So this one, it's been a popular one. You've heard me talk about this one probably every quarter on the Fireside. We talk about this, and even more so, in the meetings in between. But this is where, again, almost sort of a common sense loan. This is the cash flow loan. So let's say Don's applying for a mortgage, and well, let's not use Don for example. Let's just say somebody's, maybe someone who's self-employed and doesn't want to do the bank statement or the 1099 loans too much, whatever, the numbers just don't work out. What we're going to look at is saying, okay, you're buying this house, you're buying this $250,000 house, you're putting 20% down, and the monthly payment's going to be $1,600. And it's a duplex, and you're going to rent it out, 1,000 aside. You're going to have $2,000 rent. So $1,600 in mortgage, taxes, and insurance, $2,000 rent. You're cash flowing. In that case, you got 125% cash flow. We love that. As an investor, we're going to think that's a good deal. Obviously, there's vacancy and things like that the borrower has to be aware of, or the investor has to be aware of. But we as a lender, we're typically going to go along with that. Buyer does have to have pretty good credit. They can't be a first-time home buyer. We have to see that they've had a mortgage before, have a mortgage of their own. But this is a really clean and easy. When we get to the application and get to the income, hey, where do you work? We don't ask the question. We skip it. It's just based, think of it almost like a business loan, almost like a small business loan. We want to make sure that there's enough cash coming in to offset the expense and go from there. So this one, fantastic program. Does anybody have any questions on that? This one definitely has a bit of this one is kind of a known, this one I'd say once a week, someone calls and says, do you do a DSCR loan? I go, yes, we absolutely do. All right, good. I want one. And then I get into it. Why do you want a DSCR loan? And, because it said on the TikTok video, that's a great one. Oftentimes, um, you know, I have the conversation just saying, if you want me to look at your income, your assets, I can give you a better deal. The investor, the DSCR loan, you're paying a little bit of a premium in interest rate, not to say ask if you have a job or review any other part. So there is a financial gain or benefit to doing a full document traditional loan. So sometimes I will talk to a buyer and say, okay, we could do a DSCR, but I can save you some money if we think you qualify the other way. So just, we do have that conversation going both ways there. Don, I forget anything on that?
Well, the other reason to do a DSCR, Sean, is if somebody's adamant about titling a property in an LLC. That's the other reason you want to do that, because you cannot do that with Fannie or Freddie at closing.
Great point. And that's a big one. With just about all these programs on here, we'll let you title the house in an LLC. With a DSCR, that's routine. So it's a great point. And whether if you're doing the DSCR loan in your own name or an LLC, we're not bumping up the interest rate. It's, you do it how you want. That's fine with us. The buyer cannot live in the property ever on the DSCR loan. Cannot occupy the home. If they do, note will have to be paid in full. Big one there. Foreign national. So this is one where you have somebody who lives in, name it, Canada, England, and wants to buy a property here. Maybe that's a second home or an investment property. We can do that. It's kind of written like a DSCR loan, but they don't have to live here. We have to show that they're able to reside here. Able to visit, able to live here. Maybe they have a work visa or something like that. But it's a great program, and not a lot of lenders offer it. So regionally, this program is even more popular, kind of on the coast where you see a lot more, probably bigger price point vacation property in Florida and the West Coast and all of that. ITIN, again, we don't see this one too much, but if you're, don't have the sort of non-citizen status or don't have a social for whatever reason, there is a loan product for that. It's kind of like the foreign national program. Mixed use property. So I personally haven't done one of these here since they rolled out the program, but think about some different parts of town. Usually, we'll take Lakewood, for example. You drive up Detroit Boulevard, you have a lot of those storefront on the first floor, apartment on the second. In the Heights area, you see that still from time to time. That's considered mixed use. You're not going to be able to do Fannie Mae, Freddie Mac, FHA. Is it a residence? Is it a business? What's going on here? So we consider that mixed use, and that's typically a great option for it. So those are, when me as a loan officer, when someone says a mixed use property, I probably get the same sort of, oh geez, okay, how am I going to treat this? The same as if someone called you and say, hey, can you come list my mixed use property here in on Detroit and Lakewood? You're thinking, oh geez, what am I getting myself into? But we do have a good outlet, a good resource for that. And eventually, I'm kind of throw this out as a tease. Generally speaking, we can finance anything 4 units or under. We are going to have kind of a quasi commercial department that might be doing stuff over 4 units. So keep that in the back of your mind should something like that come up. Probably thinking first quarter of 2026, but something just I think it kind of fits similar to that mixed use. Um, Full document. So this designated for borrowers with unique financial situations. I love I wonder our marketing department kind of puts this together with our finance people, and I love that sentence. Designed for borrowers with unique financial situations. I feel like I could have that tattooed on my arm. Perfect for those with recent credit events, non-warrantable condos, or interest-only payment needs. So, non-warrantable condo is a condo that maybe is involved in a lawsuit or has some, crazy assessments being applied that Fannie Mae and Freddie Mac and FHA and nobody will touch for standard financing. So this is kind of a catch-all for that, non-warrantable condos. Somebody who maybe, hey, I'm putting 25% down, but I had a bankruptcy, maybe on a condo and my condo won't go FHA. What am I going to do? It's only been 3 years. 4 years is required for Fannie Mae or Freddie Mac. This is when, hey, if it makes sense to us, we may do that. If you got somebody with some weird, I had somebody with some real weird credit. This was actually someone on my branch who had some really, really off the wall credit issues, bankruptcy, followed by a few other things. There was a mix of some health issues and things like that. So it wasn't just like, bad credit habits. There was a lot of bad luck in there as well. And no lender would touch them. We couldn't, even consider entertaining at Fannie, Freddie, FHA, and found an option for this. It was definitely a higher interest rate, but the plan is, hey, get me in the house. The conversation more or less had saying, hey, the interest rate we're going to give you is not going to be great here. Go rent, do whatever, have someone else buy the house for you. Come back in a couple years would be get you a better deal. And they kind of said, no, just I'll take what I can get and I'll refinance in a couple years. It's like, okay, great, so be it. So that's kind of a run through. I mean, essentially, Don and I have been here at CrossCountry for 8, 9 years now, and these programs really didn't exist in the marketplace. They kind of seeped into the marketplace as demand grew, and CrossCountry Mortgage, as they have, is always I kind of take the front foot, kind of on the offense to kind of get into this game. CrossCountry Mortgage has done more of these loans, these portfolio non-QM, than anybody in the nation. Over $1 billion in loans. There's big time banks and lenders in the area here who don't do $1 billion in regular FHA, VA, conventional, and USDA. We're doing over $1 billion just in these type of loans. And again, we underwrite those. So we still have the ability to fast track these. We can issue pre-approvals on these. So, and this might be, you might not run out the door going, okay, cool. I'm going to tell everybody in the world about this. I mean, feel free, especially the DSCR. I mean, that gets a lot of investors excited. But this might be more one of those when someone says, hey, you know what? Uncle Elliot, I'd love to buy a house, but whatever. I'm 1099 and I've got a really good accountant. Now Elliot can say, we got a 1099 program for you that's might fit the bill. So anyway, this might be more of a break this glass in case of emergency. I used to look at it this way as, hey, this was the last resort. Not so much anymore. There are a lot of people who might fit into these sort of segments here, who you can go after. I mean, if you're in a networking group and if you're in a BNI group, I'd say half the people in the BNI group are self-employed. They might fall into bank statement, 1099, or asset qualifier or investor cash flow. You could easily see things like that. Or if, different networks that you're in, where we see a lot of these things from, referrals from financial planners, accountants, and attorneys. Obviously divorce can be messy and oftentimes whether it's a refinance or someone looking to purchase. So these are where a lot of this business comes from, or referrals more from that sort of world. So for what that's worth. But what any questions that you guys may have? No? No? Yeah, Don, looks like you posted the agenda there, so thank you.
Yeah.
Yeah. Does anybody have any questions on this or anything else we covered today or frankly didn't cover? No. Well, that flyer, I uploaded that. If any of you guys want, I've got some of those color copies are out upstairs and maybe in the flyer stand in the KWGM office. Feel free to swing by if you want anything, but I'll close up the fireside and say thank you all for joining us, and we'll do it again next month, and hope to see you guys at the Tom Ferry event.
Thank you, everybody.
All right, bye.